In a world where cryptocurrency continues to be shaped by global events, Bitcoin has rebounded above $63,000 amid rising geopolitical tensions. Additionally, a U.S. housing bill banning CBDCs has stirred significant conversation in the financial sector. Here are today's top 10 stories you need to know. Solana is preparing for its upcoming Alpenglow upgrade, which aims to enhance its blockchain performance by replacing its consensus mechanism with the Votor protocol, promising a finality time of 100 to 150 milliseconds. This upgrade is expected to significantly improve data propagation speeds and overall network efficiency. Additionally, there is a pending application for a spot Solana ETF at the SEC, with the deadline approaching on March 27, 2026. Holding a market cap of approximately $52 billion and trading around $90, Solana ranks as the seventh largest cryptocurrency globally. Market sentiment surrounding this upgrade remains bullish, with the potential for the ETF approval to trigger substantial inflows into Solana as the upgrade is realized. As the development unfolds, it will be vital to watch for the impact on Solana's market position and user adoption rates. In a significant law enforcement action, Europol has dismantled a Bitcoin mixing service known as CryptoMixer, which was utilized by ransomware operators and darknet markets to launder funds. Authorities seized approximately $29 million in Bitcoin and the service's operational servers, marking a crucial step in the ongoing efforts to combat cryptocurrency-based money laundering. CryptoMixer's operations allowed users to obscure the origins of their funds, making it a popular choice among cybercriminals. This action underscores the increasing scrutiny and regulation surrounding mixing services and privacy-focused cryptocurrency protocols. As governments ramp up efforts to address the challenges posed by illicit cryptocurrency activities, exchanges and services may need to adopt more stringent compliance measures. The crackdown on such services could lead to a more transparent and accountable cryptocurrency ecosystem, potentially deterring illicit activities while encouraging legitimate use of digital currencies in the future. Bitcoin's credit market has impressively expanded to $10 billion despite facing a recent sell-off. This surge can be attributed to record trading volumes and the strategic expansion of Metaplanet in Japan, which has attracted significant institutional interest. The rise in institutional leverage within the Bitcoin market indicates a growing confidence among investors, signaling a maturation of the cryptocurrency space. However, this increased leverage raises alarms about potential risks. If Bitcoin's price were to decline sharply, the repercussions could be severe, magnifying losses for over-leveraged investors. As the market landscape continues to shift, participants must carefully assess the balance between the enticing opportunities of leveraging and the inherent risks of market volatility. The current dynamics suggest that while optimism is prevalent, caution is essential. Moving forward, stakeholders will need to develop robust risk management strategies to navigate the evolving terrain of Bitcoin trading and credit. In a bold regulatory move, Hong Kong has mandated that all cryptocurrency platforms must eliminate one-time passwords, or OTPs, within 1 year. This decision arises from increasing concerns that OTPs are susceptible to phishing attacks and SIM swapping incidents, which can severely jeopardize user security. The Hong Kong Monetary Authority aims to enhance the overall safety of cryptocurrency transactions, thereby protecting users from significant financial losses. With the rise of digital assets, the region has positioned itself as a global crypto hub, but security vulnerabilities threaten this reputation. Platforms that fail to comply with this directive may face severe penalties or be required to reimburse users for losses incurred due to security breaches. As the crypto industry adapts to this evolving regulatory landscape, the focus will shift to how platforms implement these changes. The effectiveness of these new security measures will be crucial in safeguarding user assets and maintaining trust in Hong Kong's burgeoning digital economy as it navigates its future. Polkadot has experienced a significant market downturn, crashing 11% to fall below the crucial support level of 205 cents. This decline was marked by massive trading volume, indicating a broader sell-off affecting many altcoins. The cryptocurrency market has been grappling with heightened volatility recently, driven by regulatory concerns and shifting investor sentiment. As traders reassess their positions, Polkadot's technical breakdown has raised alarms about further downside potential, especially after breaching the psychological level of $2. Investor confidence has waned, reflecting a risk-off attitude amid ongoing macroeconomic uncertainties, such as inflation and interest rate hikes. The impact of this downturn could be profound, as it may prompt a reevaluation of investment strategies across the altcoin market. Analysts will be closely monitoring the market for signs of recovery, particularly how Polkadot navigates these pressures. The upcoming weeks will be critical for Polkadot as it seeks to regain lost ground and restore investor confidence in a challenging landscape. In a progressive move, Japan's government has proposed a significant policy change by reducing the tax rate on cryptocurrency profits to a uniform 20%. This adjustment marks a departure from the previous tiered system that imposed higher rates, which many considered stifling for the burgeoning crypto sector. By categorizing crypto profits separately, the government aims to alleviate the financial burden on traders and investors who have faced steep taxation. This tax reduction is expected to invigorate local Bitcoin trading activity and attract a larger number of retail investors into the market, potentially leading to increased liquidity and innovation in the sector. Furthermore, by aligning its taxation policies with other pro-crypto jurisdictions such as Singapore and the European Union's markets in crypto assets regulation, Japan is positioning itself as a more favorable environment for digital asset trading. As the proposed changes move through the legislative process, the implications for Japan's cryptocurrency landscape and overall market health will be significant. Analysts anticipate that successful implementation could enhance Japan's status as a global crypto hub in the coming years. Ripple has made headlines by expanding its XRP and RLUSD services in Singapore, following regulatory approval from the local financial authority. This strategic move allows Ripple to provide a broader range of settlement services utilizing its digital assets for banks, fintech companies, and crypto firms, representing a significant advancement in its global payment infrastructure. The approval comes in the wake of Ripple's partial legal victory against the SEC earlier this year, which has revitalized institutional interest in its offerings. The introduction of RLUSD, Ripple's innovative stablecoin, is poised to enhance the efficiency of cross-border payments, making transactions faster and more reliable. This expansion not only solidifies Ripple's foothold in Asia, but also signals growing acceptance of cryptocurrencies among regulatory bodies. As Ripple continues to adapt to complex regulatory landscapes, stakeholders will closely monitor how these developments influence its growth trajectory and the broader cryptocurrency ecosystem. With increasing institutional backing and an expanding service portfolio, Ripple aims to redefine the future of international finance. A significant regulatory development occurred when a U.S. housing bill was passed, which includes a ban on central bank digital currencies, commonly referred to as CBDCs. This legislation emerged amid growing concerns about the implications of government-issued digital currencies on financial privacy and consumer choice. Notably, it was enacted without the signature of President Trump, showcasing a clear legislative resistance to the expansion of digital currency initiatives by the federal government. The ban is expected to accelerate the adoption of private stablecoins as market participants search for alternatives to government-backed digital money. As Congress prepares to reconvene, attention will shift to the Clarity Act, a proposed framework aimed at establishing clearer guidelines for cryptocurrency regulation in the United States. The implications of this bill are profound, as it signals a potential shift in regulatory attitudes toward digital currencies and may influence how financial markets adapt to these changes in the upcoming months. As the landscape evolves, stakeholders will be keenly assessing how these developments will shape the future of digital finance and the broader economic environment. In a noteworthy development, Bitcoin and Ether exchange-traded funds, or ETFs, have reversed a streak of 8 weeks of net outflows, recording a significant inflow of $282 million. This shift indicates a renewed wave of institutional confidence in cryptocurrency markets, which have faced considerable volatility throughout the year. The approval of spot Ether ETFs in 2024 has generated excitement as this represents a pivotal moment for cryptocurrency regulation and mainstream acceptance. Additionally, active options trading has set a precedent, encouraging investors to explore diverse strategies in this evolving landscape. Similar momentum is now building for other cryptocurrencies like Solana and XRP, which are also vying for ETF approval. The deadline for these pending ETFs is set for March 27, 2026, adding urgency to market discussions and speculation. This reversal in ETF inflows may signal a broader psychological shift in the market from caution to accumulation, as investors reassess their positions amid ongoing economic uncertainties. As institutional sentiment begins to stabilize, it will be crucial to monitor whether this trend of inflows can be sustained. Continued interest and investment could lead to increased market liquidity and potentially drive prices higher in the coming months, shaping the future of cryptocurrency investment strategies. Bitcoin has recently rebounded above the $63,000 mark, reaching as high as $64,000 amid escalating geopolitical tensions, particularly between the United States and Iran. This recovery occurs as investors increasingly seek safe haven assets during fears of military conflict in the Middle East. The ongoing tensions have raised alarms about potential disruptions to global oil supply, which has in turn led to rising oil prices. Following a period of notable volatility, Bitcoin has managed to hold above the key psychological level of $60,000, a level that many traders view as critical for market stability. The reopening of SK Hynix for trade, following its significant $26.5 billion IPO, has also signaled renewed interest in macro liquidity, contributing to Bitcoin's price surge. However, it's important to note that long-term holders of Bitcoin are reportedly losing about $280 million per day, highlighting that the bottoming process may require additional capitulation before a sustained recovery can be expected. Market sentiment remains mixed. Some investors feel bullish on Bitcoin as a hedge against geopolitical risks, while others express caution due to potential macroeconomic pressures. Looking ahead, investors will need to carefully monitor global developments and economic indicators, particularly those related to interest rates and inflation, to better gauge Bitcoin's trajectory in this increasingly turbulent environment. Thank you for tuning in to today's news recap. Which story shocked you the most? Let us know in the comments, and don't forget to like and subscribe for more updates.